Welcome to the garage of forgotten things. A car that hasn't moved in years, a typewriter that belongs in a museum, and a painting so weird you wonder if the artist was blindfolded. Are these priceless treasures, or just junk quietly losing its value? Welcome to the world of depreciation. Most things lose financial value as they get older. A new car can lose value overnight if someone buys it and takes it home. A new smartphone can become yesterday's news in a few months and lose value. Even a roller coaster loses value over time, even if the thrill it gave you was priceless. All these are depreciating assets because they lose monetary value over time. Businesses, too, have assets that depreciate. For example, a factory that makes chocolates may have machines to mix the ingredients. Over time, the machine wears down and depreciates in value. Let's understand how depreciation plays out in business financials. In business accounting, depreciation is noted as an expense, and it is reduced from asset value. Let's say our chocolate machine was purchased for $50,000, and the machine has a life of 10 years. Then, every year, it can be depreciated by $5,000, making it worth $45,000 after 1 year, $40,000 after 2 years, and so on. This way, investors can understand the worth of a company's assets at a certain point in time. Depreciation also provides a tax benefit to businesses. How? To calculate taxable income, expenses need to be subtracted out from income. Because depreciation is treated as an expense, it reduces taxable income and therefore reduces the tax bill. Couple of important notes here. Even though depreciation is noted as an expense, it does not mean that cash is going out of the business. The chocolate mixing machine could be wearing down, but no immediate money is being spent because of that. Also, depreciation noted on paper is an approximation, and it may be different from market reality. For example, a machine could have depreciated by $10,000 in a year on paper, but someone may be willing to buy it for only $5,000 less after a year. So, market value depreciation can be different from paper depreciation. Now let's see what can and cannot be depreciated. A business can depreciate tangible assets such as machinery, furniture, office equipment like laptops, printers, etc. What's more, a horse racing business can depreciate its horses, and a dairy business can depreciate its cows. Really? But not every asset is depreciable. Land is an asset, but it does not wear out and cannot be depreciated. Inventory also cannot be depreciated, even if it has not sold. In what ways can an asset be depreciated? One simple way is depreciating evenly, like depreciating a machine by $5,000 annually. In this method, the same amount of depreciation happens every year. This is called straight-line depreciation. But not everything depreciates this way. Some assets, such as vehicles, depreciate more in the beginning and then less over time. This kind of depreciation is called accelerated depreciation. Yet another way is when depreciation is tied to the usage of an asset instead of its age. For example, in printing industries, the machines may depreciate more when used more and less otherwise. In such cases, depreciation is determined based on the amount of output produced by the asset. This is called unit of production depreciation. So just like the assets of a business, the rusty relics in your garage may also be depreciating. Only difference is that you can't claim them on your taxes. Now hit the like and subscribe buttons so your knowledge only keeps appreciating.